You just made money off the lows. If you are holding a real position in silver, 500 ounces, something in that neighborhood, then the bounce off the shakeout just put something like a couple $1,000s back into your account, on paper, in a matter of days. And I need to tell you something that is gonna sound strange coming from a guy who talks about silver all day. That gain is the most dangerous moment you have faced in this whole cycle. Not the drop, the bounce. Because the drop only tested your nerve. The bounce is about to test your judgment, and judgment is where holders lose the game. So let me be direct with you, because you clicked this to find out what happens next, and I am going to answer that exact question by the end. Honestly, no hype. Here is what you are going to walk away knowing. You are going to know why a paper gain off the lows is neither a reason to dump nor a reason to recklessly pile on. You are going to know what actually decides what comes next for your position, and I promise you it is not the tick on your screen. And there is one moment in market history, one, that tells a holder in your exact seat precisely what not to do right now. It is the part nobody on the financial channels will show you because it makes them look bad. I am saving it for the last few minutes, and when you hear it, the whole thing is going to click. Stay with me for it. Let me put the picture on the table in plain terms first, because the daily number does not matter, and the shape does. Silver got taken out to the woodshed. It ran down into the mid-50s in a hard, fast, stomach-turning flush, its lowest in the better part of a year, and if you were watching your account during that stretch, you know exactly the feeling I mean. And then it turned. It snapped back up towards 60 several days running, silver leading the way, clawing back a big chunk of what the flush took. Gold, meanwhile, barely flinched. It pulled back only modestly and reclaimed the $4,000 line it kept defending. Calm as you like, no drama. And the gap between those two, silver's violent round trip and gold's quiet one, pushed the gold to silver ratio, which is just how many ounces of silver it takes to buy 1 ounce of gold, up into the 70s, and then eased it back toward and just under 70 as silver outran gold on the way back. Hold on to that ratio. It matters later. So there you are. Shaken hard, then handed a gain off the lows. And here is the trap, because there are actually two ways to get this wrong, and most holders are about to walk straight into one of them. The first mistake is the one that feels the safest. You look at that bounce, that couple $1,000s back in your pocket, and a voice in your head says, take it. Take it before it goes away again. You just lived through the drawdown. It hurt. And now the market is offering you a way out that is a little less painful than the bottom was. And everything in your wiring as a human being who survived the flush says grab the gain and get to safety. That is the sell instinct, and I understand it in my bones. The second mistake is the opposite, and it feels the smartest. You look at the bounce and you think this is it. The reversal is here. The deficit is finally winning. And you back up the truck at the top of a 3-day rip with money you cannot afford to have tied up because you are terrified of missing the move you already waded through the pain to catch. That is the greed instinct, dressed up as conviction. And here is what you have to understand about both of those instincts. They feel completely different from the inside. One feels like caution, and one feels like courage. But they are the same mistake wearing two different coats. They are both a holder letting the tick decide the trade. They are both you handing the steering wheel to a 3-day price move instead of to the thing that should actually be driving, which is your time horizon and your plan. The market did not just tell you anything true about the next 5 years. It told you what a nervous, thin paper market did over a handful of sessions. And if you let that reprice your whole thesis in either direction, you are no longer a holder. You are a leaf. Now, let me tell you the story I promised, because this is not theory. This actually happened to real people with real money, and it is the single cleanest warning I know for the seat you are sitting in right now. And I want you to notice something as I tell it. It is not a silver story. It is a gold story, and that is exactly why it cuts so deep. Go back to 2008. The financial world is coming apart at the seams. Banks that had stood for a century are folding in a weekend. Credit is freezing. Every screen is red. And gold. Gold is supposed to be the thing that saves you in exactly this moment. Gold is the safe haven, the insurance, the asset you own precisely so that when everything else burns, you have something solid to stand on. So what did gold do while the world was ending? It fell. It did not hold. It did not spike. It fell from up around $1,000 an ounce down towards 700, roughly a third of its value gone, right in the teeth of the crisis it was supposed to protect you from. Now, if you own gold going into that, imagine what that did to your head. The disaster you bought insurance against finally arrives, and your insurance goes down with everything else. Every instinct screams that you were wrong, that the safe haven was a lie, that you should sell what is left before it goes to zero too. And a lot of people did exactly that. They sold. They dumped their gold into the panic. But here's the part that matters. The mechanism nobody explains, and once you see it, you cannot unsee it. Gold did not fall in 2008 because gold got weaker. Gold fell because it was strong. Think about that. When you are a hedge fund and the margin calls are coming in and you are being forced to raise cash right now, today, you cannot sell the garbage on your books because nobody will buy the garbage. The mortgage junk is frozen. The illiquid positions are stuck. So you sell what you can sell. You sell the one thing that still has a deep, liquid, willing buyer on the other side. You sell the good asset to cover the bad one. Gold got sold not because it failed as a haven, but because it was the only thing liquid enough to raise cash against in a fire. They sold the good leg because the bad leg could not carry any weight. The very quality that made gold worth owning, that you can always sell it, that it is money, is the quality that got it thrown overboard first. And now here is the turn, and this is the whole reason I am telling you this. What happened to gold after that panic bottom? It did not just recover. From that beaten down level near 700, gold went on a run for the ages. It climbed, and within about 3 years it had nearly tripled, pushing on past $1,900 an ounce to a record that stood for the better part of a decade. Nearly tripled, from the exact level where the frightened sellers were handing it over. So sit with what that means for the person who sold. They owned the right asset. They owned it for the right reason. They were correct about everything except one thing. They could not tell the difference between the asset failing and the asset being sold. They looked at a price that was falling because of forced liquidation somewhere else in the system, and they read it as a verdict on what they owned. And so they sold to recovery. They sat through the entire drawdown. They ate the whole loss. They took all the pain. And then, right at the point of maximum despair, they handed their metal to somebody else one heartbeat before it tripled. They did the hard part and then gave away the reward. That is the most expensive mistake a holder can make, and it does not come from being wrong about the metal. It comes from letting the tick tell you a story the tick has no business telling. And this is exactly why I have to stop for a second, because if any of this is landing, if you are sitting there realizing that the account you would be making these decisions inside is your retirement, your 401k, your IRA, the money you cannot afford to fumble, then this is the moment that actually counts. If you have $100,000 or more in a retirement account, this environment, a violent metal, a hawkish Fed, a market that can shake you out and reward the greedy and punish the panicked all in the same week, is precisely where the structure of what you own decides your outcome. That is why I put together a free retirement protection guide. It walks through, in plain English, how retirees are shielding their savings right now, including how some are moving a portion into physical gold and silver without triggering taxes or penalties, held inside the tax-advantaged account they already have, metal they actually own, instead of a paper claim they have to sell to somebody in a panic. If you are watching this on your TV, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. And if you go through it and want to go deeper, there is a free, no-obligation, one-on-one educational session for folks with $100,000 or more in any retirement account. Just answers, no pressure, nothing to buy. Okay, now let me show you why the bounce you are looking at is not the whole story, and here is the part that actually changes things. Because here is what almost nobody gets to, and it is the piece that reframes everything I just told you. The 2008 lesson is a warning about your psychology, but it only becomes useful when you pair it with the thing your eyes cannot see on the price chart. And that thing is this. The reason silver just bounced is not the reason silver matters. Those are two completely different clocks, and confusing them is how you get shaken into selling the recovery. Let me slow that down because it is the hinge of the whole video. The reason silver flushed into the mid-50s and the reason it snapped back towards 60 is the short-run clock. That clock is the Federal Reserve, the dollar, and sentiment. Under Kevin Warsh, the Fed has turned hawkish, openly worried that prices are still too high, and the market has had to take seriously the idea of a rate hike rather than a cut. Silver pays you no interest, so when the market thinks rates are heading higher, or merely not lower, the cost of holding metal goes up and it gets sold. When that fear eased even a notch, Silver got bought right back. That is your whole bounce. That is the weather. And the weather can soak you for a long stretch, and it will absolutely fool you into thinking it is telling you something about the climate. The climate, the long-run clock, does not care what the Fed does this quarter. And the climate under silver is a physical shortage that has been building for years. The silver market has run a structural deficit for 6 straight years, meaning the world uses more silver than it mines, year after year after year, and it has plugged the gap by draining above-ground stockpiles, hundreds of millions of ounces pulled out of vaults to cover the hole. Nobody engineered that. It is solar panels and electronics and every circuit board and every electric motor on Earth quietly eating silver, and crucially, not giving it back. Because here is the difference between silver and the gold in my story. Gold gets hoarded. Nearly every ounce ever pulled from the ground still exists somewhere. Silver, more and more, gets consumed. It gets spread across a solar farm and flexed too thin to ever economically recover, soldered into devices and thrown away. Gold is hoarded. Silver is burned. That is a shortage no rate decision can unburn. And you can see the physical pull most clearly in China, which has been draining the physical silver market, its imports surging to record levels, its domestic inventories drawn down so hard that at the stress point, silver inside China traded at a steep premium to the price in London. When the price in one place runs above the price everywhere else, it means metal is being physically yanked in that direction, faster than it can be replaced. Part of that is Chinese industry racing for solar metal. Part of it is ordinary Chinese savers, priced out of expensive gold, rotating into silver as the affordable hard asset, the poor man's gold. And copper, silver's industrial cousin, has been printing prices near record highs on the electrification build-out. And most silver is not even mined on purpose. It comes up as a byproduct of digging for copper and lead and zinc, so even a copper boom does not reliably bring much new silver with it. Inelastic supply, relentless demand. When neither side flexes to the price, the only thing left that can move is the price itself, which is exactly why silver whips so violently in both directions. The flush into the mid-50s and the snapback towards 60 are the same coin. So let me lay out the bull case honestly, as the case a growing number of serious analysts are making, not as a promise from me, because I do not make promises about prices, and neither should anyone you listen to. They point at that ratio, near 70 today, and they note it hit around 17 at the peak in 1980, and they argue that a stretched ratio has historically tended to compress, and that it compresses because silver outruns gold, not because gold falls. Run the arithmetic, and it is just division. If gold merely holds near 4,000, and the ratio compresses back toward levels it has actually visited before, the number that division spits out for silver climbs into the low hundreds, and at the tighter historical ratios, into a couple hundred and beyond. That is where you hear figures like 130, 250, even 300. Those are not my forecasts. They are the numbers these analysts reach when they assume the deficit keeps widening and the ratio keeps compressing, and triple-digit silver, which sounded insane not long ago, now sits inside mainstream bank targets. At the boldest, most speculative end, there are voices arguing for four-figure silver on a full monetary reset, and I am telling you what they argue so you understand the extreme case, not because anyone can hand you that number or a date. The bigger the number, the more it leans on assumptions stacked on assumptions. Treat the precision with real skepticism. And now I am going to keep my promise and be honest with you about the risk, because you have earned the truth and because the 2008 story cuts both ways. I cannot promise you a price. I cannot promise you a date. And the moment anyone does either one, close the tab. Silver is the most brutally volatile major metal there is. It just shook out into the mid-50s and snapped back towards 60 in a matter of days. And it can turn around and do the exact opposite just as fast. A few good days off the lows is not a confirmation of anything. The reversion might not come. It could stay cheap. It could fall back below where it bounced from before any of this plays out. And even if the bulls are dead right about where it ends up, the road there can take years, and it can be vicious. Being right and being early feel identical the entire time you are holding through the pain. Even gold in its great run had a drawdown of roughly 40% in the middle of it while the thesis was working perfectly, and it shook out plenty of people who were completely correct. In the short run, the price does not answer to the deficit or to China or to copper. In the short run, it answers to the Fed and the dollar and fear. The shortage is the trend. The Fed is the weather. Never confuse the two, and never let the weather make you sell the trend. So here is what all of this means for your actual position, the concrete part, because you asked what happens next, and you deserve more than a shrug. What happens next is not up to the bounce. It is up to you, and specifically up to whether you built your position so that you can hold it. That is the whole game, and it is the lesson underneath 2008. Own the metal, not a paper promise you have to dump to somebody in a fire, but size it. And I mean this seriously, so that no shakeout can ever force you to sell at the bottom the way the frightened gold owners were forced in 2008. If a drop to the low 50s or lower would put you in a position where you have to sell, then you are too big, and you should fix that in the calm, not in the panic. Do not grab the paper gain just because it appeared. Do not back up the truck at the top of a rip because you are scared of missing out. A bounce is not a signal to sell, and it is not a signal to chase. It is a moment to check whether you are built to hold, and then to go back to living your life. Your time horizon decides your outcome. The tick decides nothing, unless you let it. So what is next for the 500-ounce holders sitting on a gain off the lows? Here is the honest answer, and it is the answer to the exact question you clicked on. Nothing about that gain tells you to sell, and nothing about it tells you to pile on. It tells you the market gave you back some of what it took on a short-run clock that has nothing to do with the long-run reason you own the metal in the first place. The people in 2008 who owned the right thing for the right reason and still lost did not lose because the asset failed. They lost because they could not tell the difference between the asset failing and the asset being sold, and so they handed away the recovery they had already suffered through the drawdown to earn. Do not be that holder. Do not do the hard part and then give away the reward. If you waded through the flush into the mid-50s, the one thing you must not do is sell the very recovery you waited for or blow yourself up chasing it. You survive to be there. That is the entire job. If you are on your TV, the QR code is on your screen one more time. If you are on your phone or your computer, go to jeffreedguide.com. It costs you nothing to be informed, and the time to think this through calmly is exactly when it does not feel urgent, which is right now, before the next flush, not in the middle of one. And for those of you who stuck with me all the way to the end, here is what I promised you at the start. If you have $100,000 or more in any retirement account, and you mention that you watched this full video, you can claim a free one-on-one, no-obligation educational web conference. A real conversation about your specific situation, about what you actually own versus what you think you own, with no pressure and nothing to buy. That is only for the folks at that level who made it all the way here, and you are one of them. If you are on your TV, scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. Grab the guide and take the first step toward protecting what you spent a lifetime building, because you already did the hardest part. You held through the drop. Do not let a bounce in either direction talk you out of the recovery you already owned. Do not just survive the shakeout. Be around to see what it was for.